option they have weekly, they have a monthly. Monthly one normally is third week. Okay, so normally okay, they will show you the third week one. Okay, let's say this is the third week one. Okay, and this is November 20th expiring date. Okay, now Apple price is 112. Okay, so you look at in the money 112. Okay, so you want to buy the call or you want to buy the put. Okay, you can, or you can combine. And this is the thing we're going to learn later. All right. Okay, so basically if you think Apple will go up, you can buy. You think Apple will go down, you can buy put. Okay, this is for you to, you think Apple will go down, this one you think will go up. Okay, done. Okay, the last price okay, here is 5.50. Of course, when the market open, the price will change one. Okay, you can ask me in Mandarin also. You can ask me in English and BM also. Only no Tamil. Okay. Any question? Done. Done. Are you there? Jackson, are you there or not? Okay, let's say this price. Okay, all this price. Okay, basically, okay, why the price is different? Okay, because of course the strike price is different. Okay, this is all we're going to learn lah tonight lah. After we learn all this, you will know, oh, why the price like that. Okay, whether should I buy or should I sell, that kind of thing. Okay, but the most important thing you must know up here is actually the expiring date. Okay, in the middle here, okay, is the strike price. Okay, this is a contract price. Okay, and then this side is call, this side is put. Of course, there are a few variables it's not showing here one. Okay, those variable is going to show on the front page of the stock one. Okay, let's say you can see okay, you can see here is IV. IV actually is very important component. Okay, later we're going to learn what is IV is. IV is implied volatility. Okay, so and then when you click the options okay, let's say you think you want to buy options okay, 112 in the add the money, you want to buy it. Okay, you click this page also very important. Okay, you can see, okay, what is the profit probability, what is the delta, what's the gamma, what's the theta, all this we're going to learn tonight. Okay, you know what I mean? Okay, so and then you can see the delta also. Okay, you know what I mean or not? Okay, so basically this is all we're going to learn. All right. Okay, so basically you see a delta, all this thing, all this thing are we going to learn. Okay, so any question?
Mike, do I have to lock out the portal in order to go to the handphone one?
I believe no need, I don't know. Sometimes I think if let's say they allow you to only, actually now I'm using I don't know, maybe you can try it. Okay, if let's say you can log in both side also, I think. Okay, if they say another one is logged in now, you terminate, you just terminate it lah. You get me or not?
Okay.
All right. Yes.
So cannot cancel.
Sometimes actually both you can log in because the security feature is already by your pins normally you before you log in you have pins okay, yeah, so you see how's your browser work lah.
Yeah, so click OK to log in and disconnect the other session.
Yeah. Okay, so yeah, so I believe everybody know how to read the option table and then the option this and that. And today you will see also what is called profit probability, okay, what is delta, what is gamma, what is theta, okay, what is delta, all these things tonight we're going to learn one. Okay, you don't need to feel worried. Okay, so this is a very important about why you need to, you must understand option first. A lot of people say, hey, tomorrow I know Apple is going to go up to today I buy options sure make money may not necessary. You get me or not? Okay, you get me or not? Okay, so I'm going to start today's the class lah. Okay, so basically we're going to off this one first. We're going to off whatever possible so it is easier for us to learn lah. Okay, actually today is supposed to got one candidate ladies one, but now it's good lah, all guys now, so we can talk a bit nothing lah, just to wake your guys up, in case your guys are feel sleepy, or not. Okay, so basically before that, I don't make my disclaimer. Today, this is an educations, but like I say already, okay, I hope you guys really learn, okay, and I call this option 202 lah. After this option class, right, your guys can start trading already, and I hope your guys can start make money already, and you use that money go to option 303 if you want. If you don't want, it's okay, okay. You see or not? Because after this, you can already no more already. After that, you can start using it to start making money first, okay, and then you question can ask first, okay. And the last class will be option 303. That one is very, very complex, okay. So I may not continue that part also, okay, or you may also know already. You get me or not? Okay. So okay, number one here we need to know here is what determine the option price. Okay, why the option price you see just now one is like that, it's like that, it's like that, you know. Okay, options are actually is basically is we give an example, it's just like insurance lah. Okay, if you want to buy a longer term insurance, it is more I would call it more expensive. You need to pay more premium. Okay, so if you want to buy shorter term insurance, it's cheaper because the risk is not so high. Okay, so that is called theta, okay, in options. Later we're going to talk about that value. Okay, so options actually the price is determined by two things only: intrinsic value and extrinsic value. Okay. What is intrinsic? What is extrinsic? Okay, you can see here. Okay, the intrinsic value is the green line one. Okay, normally, okay, the extrinsic value is the one is the cream lah, we say lah, especially when you want to sell options, okay, because when the day is go by, okay, the time decay, the theta become negative, losing the money every day, okay, you were getting the premium more and more and more. All right. Okay, so basically then you look at the option price, okay, it's actually combine both the intrinsic value and the extrinsic value. Okay, I give you an example here. Okay, how to calculate an intrinsic value. Intrinsic value is very, very simple. Okay, we give you a call option now, let's say. Okay, so the value of exercise option as opposed to buying and selling share at a market price. Okay, I give you an example. Let's say the stock price now is 200. Okay, you look at the option table. Okay, what is the intrinsic value? Okay, intrinsic value is 50 lah, correct or not? Okay, because the strike price plus the 50 is the 200, the current price. Okay, so basically meaning that if you on the call today, okay, at a strike price of 50, you can actually immediately exercise it. Of course, you will get 50 also lah. Okay, so nobody will do that lah. You get unless you want to exercise one lah. Okay, you get me or not? Okay. So if let's say the call strike price is the strike price just now we see on the table one. Okay, let's say the intrinsic value, okay, of the call is 25 lah. Okay, so anything higher than 200, the intrinsic value is 0. It's very simple. Why you want to buy the option? If let's say you want to buy the options at 210, if let's say you can buy the stock at 200, correct or not? You understand me or not? Okay, nobody want to buy the options at higher than 210. Okay, why? Because but of course in reality God okay, I just let you know in a nature thing let's say nothing happen in the future, whatever, no, don't have others things factor in okay. I want to ask you today, you want to buy something, the same thing, you want to buy at 200 or 210? Of course at 200 correct or not? You buy the lower price. Any question or not? Okay, so that is why, okay, the intrinsic value, okay, that means that the intrinsic is no value anymore. Let's say the option is 210. Okay, but however, option price got two components. Okay, whatever higher than 200, okay, will be the extrinsic value already. Okay, we're going to study what is the extrinsic value, the coming slide also. Do you understand or not this slide or not? Before we go further.
Yes,
You can
Mike.
unmute
Okay.
your mic now. Okay.
Oh, yes,
Yes.
yes, yes.
Okay.
Yes.
Okay.
Yes.
Good. Okay. So once you
Yes.
understand this is very easy lah. Okay. Okay, what is called intrinsic value? Very simple. Okay. Okay, when the call strike price, okay, the call intrinsic value. Oh yeah, I forget to record now. Oh, ah, never mind. You hold on for a while. Let me go to the record. Next time, remind me to record. Peter, remind me to record. You hold on for a while. Why like that one? Okay, never mind. I will start from here lah. Okay, so what is called a call intrinsic value? Okay. Okay, a core intrinsic value, okay, sorry, recording, yeah, okay. So, it's the value of being buy a share at a call price as opposed to the current stake price. Okay, how you going to get the core intrinsic value? Very simple, we're just saying that, okay, the stock price minus the call strike price, okay, you will get the intrinsic value, okay. For example, okay, 140 call, okay, over 150 stock now is a $10 intrinsic value, all right. Okay, so for the put one, what is the intrinsic value? Okay, so call one, I believe you know lah. Anything above, okay, the current strike price, okay, is zero. Okay, the intrinsic value. All right. So let's say Apple stock now is 112. Okay. So above 112, there are no more intrinsic value already. The call options. Okay. What you can see one, all the price they are extrinsic value already. You know what I mean or not? Okay. So maybe I try to go into the uh, example here lah. Okay, at least you guys can see. Okay, we're using Yahoo because Yahoo is very good. Okay, we look at Apple again. Okay, why we're using Apple is because Apple is a very good. It's a very good I would call it stock to for you to trade options. Okay, we go to options. Okay. Okay, then we go to trader. I like to using trader lah, okay, because I can see both side call and put. Okay, so meaning that, okay, uh, above all these price, all these are extrinsic value already. Why today the extrinsic value of Apple so high? Because earning, okay, because tomorrow morning is earning, okay. Normally, right, one day before it's expired, right, the extrinsic value is very, very low already. But today you can see Apple, okay, still got the intrinsic value like $2 something is considered very, very high already. Okay, why they still got this kind of value? Okay, it's because of, okay, the earning. Okay, now my question here is, okay, based on the current price now, okay, let's say Apple is trading at 112. Okay, what is actually the intrinsic value of 109 core? Anybody can answer me?
Three US.
What I mean?
112 3.
Yeah, good. Okay, so I believe who is this? Alan, right? Correct or not? Yeah,
No,
so
it's somebody
those
else.
actually who answer me one, you just identify yourself, Alan here or
Jimmy.
Nash here or what, you know. The reason actually is very simple because I want to see who is really learning, you know. Like I say, honestly speaking, this is not an easy money to earn your guys. This is, to be very frank, you know, is considered as very, very low price I charge your guy, okay. But yet also I want everyone can learn. Okay. Okay. So understand, okay, so it's $3, the intrinsic value. But when you look at here, why the option price is $4.32. The balance is extrinsic value. Okay, now my question here is, what is the extrinsic value? Anybody can answer me?
$4.32.
1.32.
1.32.
Yes, 1.32. Get it? Everyone get it? It's a very simple mathematics lah. You get me or not? All right. Okay. So in summary, the call options, as long as the price above the strike price is called, all called extrinsic value. If below the strike price, they still have intrinsic value and extrinsic value. To get the intrinsic value is very simple. You're using the strike price minus, okay, the option price, okay, the strike price lah. You want to buy lah, for example, 102, you will get $3, okay. But when you look at it, why not $3 one? Okay, of course, because they have extrinsic value there. The extrinsic value is 1.32. That's for call options. Understand, right?
Yes, Mike.
Everyone understand? Before we go further?
Okay.
Yes, yes.
Okay, good.
Yes, yes.
Okay. Yeah, okay. So if you don't understand, you just stop me, because you pay here. I don't want, I don't like leceh one, because I want you guys really understand. I want you guys to make money, You get me or not? I don't want people charge 4,000, 5,000, 10,000 one gong gong okay, gong gong 出来 okay? You get me or not? Really a lot one, I tell you. You see or not? Because they got motivated, they go to the preview. Wow, yeah, so until the whatever thing like the 2-3 days, they don't know what the heck they are learning. You get me or not? Okay, because the class is too big, they don't have chance to ask. So I don't think there's a ethical way to make money lah. But tonight, to be very frank, okay, we have a very small class, and I want you guys to learn things. Okay, so you must understand all these things. Okay, so we go back to the slide here. Okay, because I go slow, because those who understand, you just pretend okay lah, never mind lah, don't not say boring lah. Okay, because I just want everybody to understand. Okay, so in the money called intrinsic value versus extrinsic value. Okay, when you look at it, okay, stock more than 5 has intrinsic value. Okay, you see or not? Okay, so basically stock less than 5, okay, is all intrinsic. This is a put or what? I think this is a put, right? Okay, this is a call or put, or this is a call price. Okay, okay, so as the expiry approach, extrinsic value diminish. Okay, that means disappeared, leaving only intrinsic value. You get me or not? Okay, for example, okay, this is 105, and then in the end of the days, okay, you can see okay, between this period of time, you still have extrinsic value. The extrinsic value will go up and down, up and down, up and down. But in the end, the extrinsic value tak ada already. Okay, so if the option expired at the price of 110, example, okay, 110. Okay, so basically in the end, you can see all left is only $5. This is all left. This is called intrinsic value. You know what I mean or not? Okay, so what left in the end of the expiring is all intrinsic value only. That's why just now I tell you, okay, why Apple only have 1 day expiring, and why the intrinsic value is still so high. It's almost 2-3%, it's considered very, very high, because tomorrow morning Apple is going to announce earning. Okay, so that's why expectation, the uncertainty there is still very, very high. That's why the extrinsic value there is high. You know what I mean? Okay, I believe everybody understand. Okay, if understand, I will go. I will actually I will go to the next slide already. Okay, so this is in the money. Okay, just now, just same like what I tell you guys is now 109 and 112. All right. Okay, now is out of the money called intrinsic value. Okay. Okay, this is out of the money or not? I worried. Yeah, out of the money. Okay. This out the money. Okay, because of if less than that, okay, call is all extrinsic value. Okay, because I worried the slide. Okay, let me see. Okay, 105. No, these two slides are the same, right? That means okay. Ignore this one. This is okay, more than 105. Okay, call has intrinsic value. Okay, call is all intrinsic value. Yeah. Okay. Okay, so okay, what is actually a put intrinsic value? Okay, the value of being a share to sell at the price. Okay, for example, put price. Okay, minus the stock price. Okay, okay, this is the balik. If let's say you look at just now, okay, if call have intrinsic value below the strike price, but now, okay, put okay, have the intrinsic above the strike price. Why? Because you want to sell higher than the current price. Okay, so example 165 put on the 150 here have a $15 intrinsic value. All right, okay, so any price that below the strike price, okay, the intrinsic value is 0. Okay, however, again, you look at reality, let's say we look at reality again, okay, is that the call intrinsic value is equal to 0? No. In fact, the intrinsic value is very, very high, it's 298, 240, $2 something. Okay, this side is a put. Okay, so all this value is called extrinsic value already. Again, why this happen? Because tomorrow is Apple earning. Tomorrow morning, our time, 4 or 5 a.m. is our earning. Okay, so the risk, the uncertainty there is still very, very high. Okay, this is the reason why, okay, the extrinsic value there is still, okay, very, very high. Okay, so if you look at those earning already past one, okay, I give you an example like AMD. Okay, you look at AMD, okay? Okay, you look at AMD, okay? You look, they still have extrinsic value, but the extrinsic value is not really that high anymore. It's lower already, okay? Because the earning of AMD, if I'm not mistaken, already passed already. Okay, you can see the earning is here already passed already. Okay, so basically, but why AMD is even 1 day left? Because later we're going to learn this lah, okay? Because AMD has a very high beta. Okay, so meaning that the stock fluctuate, okay, the historical volatility is very high. Okay, so it will actually compare to current one, the IV, okay, and then it's still consider, okay, it's I mean, not bad lah, okay. You look at percentage wise, right, it's almost like 1% okay, the put in extrinsic value, and the core one, the extrinsic value, okay, is still okay, I mean, those are near the money one lah, okay, not at the money, but near the money one is still very high. Okay, okay, so even okay, we look at one stock. I hope this stock got what got option change lah, because some of them don't have one. That's a Coke, okay, KO, Coca-Cola company. They have 31. Now this is a very good example already lah. Okay, okay. Now you look at the extrinsic value. Is very, very low already. You get me or not? Okay, okay. Why? Because Coca-Cola generally is not a very high beta stock. Okay, so basically, Warren Buffett normally, in fact, actually he trade options also, So I think Warren Buffett normally will actually short the put here, short the put, collect all the premium here. This is his style lah. You get me or not? Okay. So basically, because of the beta of this stock is very, very low, and then of course it impact the implied volatility. So basically, in the end, okay, only left 1 day only. So basically, you can see, okay, this is less than 1% already. Okay, it's less than 1% already. Just now it's more than 1%. Okay, even the same day of expiring that. Okay, so if all this side one is called extrinsic value, okay, here is intrinsic plus extrinsic. Okay, here is intrinsic plus extrinsic. Get it? Okay.
Mike, from this graph, how do you know the intrinsic value is what high volatility?
Now the high volatility side actually is not from the graph, it's from the nature of the stock. Very good question. Okay. Normally, okay, high speculated stock, high tech stock, tech stock, you know what I mean? Okay, technology stock, all right, okay, have a very high volatility, all right, meaning that in the history already show that, okay, this price, they actually the IV, the implied volatility is very, very high if compared to like Coca-Cola, compared to McDonald's, that kind of thing.
To look at the volatility, just like you mentioned, is to look at the beta, right? The higher the beta reading, the more volatility, no? Right?
Yes, definitely.
Oh,
Okay,
okay.
definitely. Okay, because beta actually is a comparison between the share price, the stock price movement plus the S&P 500. Okay, that means actually it's the benchmark of the mother lah. Okay, see or not? Yes, possible, definitely. Okay, especially the during the COVID, all these things, those are people, those company who produce a vaccine one, okay, because of people are betting on their stocks. Okay, so basically, the beta the implied volatility, and indirectly the beta the over average beta will go up or the implied volatility will go up. You get me or not? That one definitely is all the nature of the stock, or no? Okay, you get me or not? In the end, we still look at the mother. Okay, the mother actually is a stock. Okay, just look at stock option is just like the child only. You get me or not? Okay, the child actually is all depend on how the mother react. You get me or not? I just give you a very good example lah. Okay, because beside warrant, beside option, they have a warrant. Warrant also is maybe like the second brother. Okay, the big brother is like options. Okay, but both of these brothers, okay, their attitude maybe okay, is impact by the mother one. Okay, this is the way easy to illustrate it lah. Okay, so the most important thing you must know, okay, what is intrinsic value and extrinsic value lah. Okay, so this is a out of the money put. Okay, so give an example, like if the stock price currently actually is more than 80, okay, so put is all intrinsic. If the stock is less than 80, okay, put has a intrinsic value. All right, okay, this is a put. Okay, yeah, okay, so basically you can look at it, okay. Now, okay, this is, I think, something wrong. Okay, more than 80. Yeah, more than 80. Okay, it's more than 80. Okay, so you can see this is the extrinsic value. Okay, so basically, as the time decay, you can see what happened to the extrinsic value. Boom, becomes zero. You know what I mean or not? Okay, so meaning that the higher, the longer the option is. Okay, basically, okay, uh, the extrinsic value will decay, or we call it time decay. Okay, there's another thing we're going to discuss one. It's called theta lah. Okay, theta or whatever lah, the lah. Okay, theta lah. Okay, so basically this is a put, out of the money put. Okay, this okay. So what determine the extrinsic value are? These are the two things. Okay, number one actually is a time to expirations. Okay, so basically if you can see, if no earning, if no any big event like next week, another reason also because why the so-called the premium, okay, or the extrinsic value is still very high, okay, is because of the next Tuesday event, lah, the president elections. Because normally I see Coca-Cola premium also quite high, normally Coca-Cola not that high one. Okay, so basically that kind of event, okay, will impact, okay, overall, because that is the biggest, one of the biggest event in a financial market, not only to stock only, to all the asset class, including the gold, including the index, including everything lah. You get me? Okay, so basically if non have that kind of event, okay, we look at it normal only, okay, not big event lah. Okay, you can see, okay, as it nearby to the day of expirations, okay, your extrinsic value will become less. Okay, and it's far from the day of expiration, that is T to E. Okay, you can see the extrinsic value is very, very high. Okay, of course you will say, oh, like that, is very good. I can say options are very high in the futures. Okay, and I get yeah, possible. Okay, so why actually is very high? Okay, it's very simple because there's still a lot of uncertainty. Okay, still a very, very uncertainty, because time is one of the uncertainty element. Okay, so as long as you know, the longer the option expire, okay, the extrinsic value generally very, very high. Okay, another one here is, okay, is the implied volatility. Okay, to determine the extrinsic value. Okay, this is the volatilities. Okay, so what is implied volatility? We're going to go through the next few slides. Okay, this is a very important element in options. Okay, very, very important. Okay, data is very easy to understand because the value is there already, but however, implied volatility, or we call it IV, is not easy to understand. Okay, okay, because IV, the variable to determine it is not the day by day one. Okay, it's all the nature of the stock, the event happening, you know, and what the demand of and the supply of the options, okay, which actually determine the implied volatility. In fact, actually, implied volatility is the one of the components that even the expert, the professionals of finance or whatever, the hedge fund, they cannot determine one. Okay, if they can determine correctly implied volatility, right, I can tell you they can become very, very rich already. You know, how can we determine? We don't know whether it's a Biden or Donald Trump win. You know what I mean? Okay. The only thing is we know the uncertainty is very, very high. That's why the implied volatility, okay, these 2 3 days is very, very high. Okay. But after these 2 3 days, you can see the implied volatility definitely will go down a lot. Okay, unless big thing happen again. Okay. Normally the implied volatility is getting higher and higher normally when the options have earning, just like what I show you just now, Apple. All right. Okay, so you can see that, okay, as higher the implied volatility, of course, the more extrinsic value. Okay, so a high options price, okay, generally, okay, is the longer expiration, okay, and then the high IV, okay, or the high implied volatility. Okay, understand or not? I believe you can understand now, right? Okay. For what is implied volatility, we can took it now. Okay. Is the stock expected volatility implied by the option price? Again, you see or not? Okay. Why people say if you in, let's say you're in this Wall Street okay, when you talk to all those so-called those expert, okay, they will tell you, wow, okay, the IV is high. Okay, when they say the IV is high, normally the stock price sometimes don't change it, only the option price change, but when they see the option price change, they know something happened already. Okay, so if you can read option price, you can scan option price very, very well. Okay, those we have a lot of time one, right? You go and scan it. Okay, so those stocks suddenly have a spike of the options price, then you know something happening already. Okay, I told you guys already in options 101. Okay, 2 months before the 2 months before the what do you call that? 2 months before the 9/11. Okay, the airline, okay, a lot of people buying put. During that time, the option price, when people buy, of course, the demand is there. The option price will spike. When the option price spike, okay, the IV will go very, very high already. And if you know something is happening, what you can do here is you can buy the put, okay, or you can short the stock already. Okay, even the stock is not moving yet, but the option price is moving yet, because you cannot move the future price, stock price. Am I right? Okay, so even how can you move, because the stock price is present one. The only way you can buy options, okay, in the futures one, expiring in the futures one, okay, to make money if you know something is happening. So that is a good thing why we have option. Let's say you worried, okay, you can buy put, especially for this or next week, to protect your position. Okay, because you know certainly, okay, the market will be volatile. Why? Because of the earning season, because after that followed by the president elections result. Okay, so these two event is enough already to determine, okay, the implied volatility is very high already. Okay, so implied volatility, okay, can be interpreted as the market expected magnitude of the stock price change in the futures. You know what I mean or not? Okay, if you can see the implied volatility of the put suddenly go up, okay, then you know something is happening. Okay, or the call something, the IV is go up. Because why? Because people start buying the options or buy the put or buy the call. Okay, so when people buy, the market is all supply and demand. Buyer more than seller, okay, price will go up. Okay, same go for put or go for call. All right. Okay, implied volatility extrinsic value, okay, amount of extrinsic value that exists in the stock option relative to the time until its option expire. Like I said just now, okay, we mentioned already, okay, as the longer the stock expire, okay, the more extrinsic value. Okay, so basically, of course, when longer expired, of course the IV is higher like, because the risk is higher. Okay, so if tomorrow, if nothing, let's say no earning season or whatever, tomorrow options, okay, you can see, okay, the extrinsic value is very, very little already, and then the IV normally is very, very low also already. Okay, so basically, if a 1 year ahead, okay, you can see the extrinsic value is still very, very high, and the IV is definitely is higher than what happened tomorrow one. I believe, what I assume here is, if nothing happened, like no earning season, no president election, whatever it is. All right. Okay. So the stock price, okay, you look at this stock price, okay, which one got a higher IV? Okay, A or B? When you look at the
B.
option price, yeah,
B.
B. Of course, it's B lah. Okay, you look at this, you know already lah. This is something like we can actually use it like Coca-Cola and maybe Micron. Okay, Micron actually and Coca-Cola, the stock price are almost the same. Okay, but today it's very difficult to me to illustrate because of the elections and the earning season. Okay, but normally next week after the election, 1 or 2 weeks after the election, you can see. Okay, you can try to look at Micron, and Micron, the ticker is MU. Okay, and Coca-Cola is KO. Okay, you can see both of the coal price, you know already. Wow. Okay, why Coca-Cola so boring one? Okay, why the coal price is very low, but Micron is very high? Okay, from there you know Micron has a higher implied volatility. You know what I mean? Okay, guys, I stopped a while for 5 minutes. Okay, you guys try to digest. Okay, and you try to look at the stock price. Okay, you can actually go to Yahoo. Okay, and you can search whatever stock. You can look at the expiring date. Okay, and you want to based on the current one, and expiring date, and the futures expiring date. Okay, and you can look at the list also. Okay, now you look at the list and you can see the implied volatility already. All right, because this market is not open yet, so normally it's 0. Okay, so this implied volatility normally change every second one. You know what I mean or not? Okay, because it depends on all the option price. Okay, but again, I tell you already, don't worry about this part. Okay, there is no 100% accurate one. It's just a normally the option price is just based on, okay, the last price that you want to trade. Okay, so you try to play around with this. Okay, you try to look at this, what is this, what is that. Okay, then later on, we continue 5 minutes later, because I need to have a drink some water. All right. Okay, so I think everyone's still following, right? Correct or not? Hello.
Yes.
Yeah. Okay.
Yes,
Yeah.
right. That's
Yes,
right.
yes, yes.
Yeah. So okay, it's very important. Okay, so the next slide, maybe let your guy interpret first lah. Okay, before we go before we continue. Okay, it's very, very simple. Okay. When the option buyer are willing to pay high premium, like I say, okay, when 2 months or 1 month before the 9/11, okay, why a lot of Middle East people willing to pay a high premium for the put, okay, because they know something is happening already, okay. And option seller demand a higher selling price, okay, then indicate the trader expecting of the stock price volatile in the future. Volatile not necessarily go down and go up, it can go both way one. Okay, this is very, very important. Okay, so high volatility is implied by the option price. This is very important. A lot of people thought, uh, implied volatility impact the option price. No, okay. Implied volatility cannot move itself one, okay. But option price, yes. Option price actually is all based on the event happening to the mother stock. Okay. So when people start to buy options, it may imply something, okay. The stock will go up. If let's say it's a call options, if a put options, the stock will go down. If a low volatility is implied, okay, so when option buyer are not willing to pay high premium, just like Coca-Cola, okay, because people say boring like this stock, people already predicted the earning how already, okay. It's like tech stock is more difficult to predict if compared to a stock like Coca-Cola, McDonald's, this kind of thing. You get me or not? Okay, so basically the premium is very, very low. Okay, so basically the seller only willing to sell the premium very, very, very cheap price only. Okay, so basically when this thing happen, okay, those boring stock normally their volatility, okay, is very, very low. Okay, so basically how are you determine, okay, the a range, okay, of the stock? This is the most important element in option trading. Okay, very, very important. Okay, so to get the implied volatility, okay, you can get it from the data. Very, very easy one. What just now I show you already. Okay, that is really a last price. You can get it from the handy trader there, the IV there. Okay, the IV they show you 39, but let's say they show you 39% or 20%. Okay, just now you can see, okay, the AMD is 52%. Okay, okay, so the IV is very, very high. Okay, so basically, this is actually annualized IV, meaning that actually is a yearly IV lah. Okay, so you want to get a daily price, okay. You still remember like today's sometime I will send your guys, okay, but these few days I don't like to send is because of the event lah, okay, the earning event, and of course the president elections event. So basically, if not, okay, you will get, actually you can calculate, okay, the daily price range also. Okay, so the day range price, okay, basically we will use a formula to calculate it. Okay, so basically you can see, okay, the higher the IV, okay, the range is bigger. Okay, or they call it a one standard deviations lah. Okay, if those people who study deep in finance one, okay, like you know what's called standard deviation. Okay, it have a bell curve like that. Okay, so basically the stock price, okay, give an example for Netflix, okay, is 374. If let's say the IV is 39, so you will know the the Netflix will fluctuate, okay, in between, in 1 year, okay, it will between, okay, 228 and 519. How to get it? It's very simple only, okay. You're using 347 times 1.39 for the high side, and you then after that, or you get the range first, okay, and then after that you minus it, you get the low side. Okay, you look at Coca-Cola, it's very boring. Okay, the IV is only about, okay, 20%. Okay, so the standard deviation here, okay, is 1 year is only $41 to $62. Okay, from this part, a lot of people, especially when you want to choose stock to trade, right? Okay, sometimes not necessarily you look at the stock IV is very, very high. Okay, they will give you a very good chance to sell options or to buy options, up to you lah, up to your interpretations. Okay, but you have to compare to the historical volatility. Okay, so if it higher than historical volatility, meaning that then actually that may be a good time for you to either I basically sell lah, because we look at high IV here, we want to sell it because the premium is very high. Okay, so you have to, if you really focus on few stock one, you really cannot see, okay, whether, okay, this IV you cannot compare stock by stock. You know what I mean? I give example, like if I buy Micron or I buy AMD, this is a real thing lah. Okay, I buy AMD IV is about 52, but I buy Coke also. Okay, Coke is 20. The IV, look at the last IV is 20. I will say, today the IV of this AMD is very high. If you do like that, it's not really that correct, you know. Okay, it's because you have to compare, okay, the past or the historical volatility, or we call it HV. Okay, so if the historical volatility of the AMD is 60%, today is 52, will they consider as high? No. Okay, but if the historical of Coca-Cola is only 10%, today is 20, will they consider as high? Yes. You know what I mean or not? So basically, when you focus on one stock, okay, not necessary, okay, the high IV, okay, for that stock that they consider as a high. Okay, you know what I mean? Okay, so basically, but if you don't understand that part, it's okay. But the most important thing you must understand, okay, why we study option is we want to get a range of the price the stock will go in 1 year, in 1 month, in 1 day, in 1 week. Okay, because when you get this range of price, you can do the wonder already with all the strategy. Okay, it may not 100%, okay, but the probability of profitability is almost 70% already. You know what I mean? So if the probability of 70%, okay, if you trade more, okay, the profit probability is 70%, you trade every day, okay, and even you win 5 times, okay, you already profit already. Let's say you even lost 5 times, you win past you lost 5 times. However, your profitability is 70%. Okay, meaning that the winning, the edge that already on your side. Okay, this is how the casino make money also, you know. Okay, because casino, they know, okay, the moment you sit down, okay, maybe it's 50-50. Okay, but as times go by, right, okay, your probability of winning will getting less and less, and less. Okay, so they want more people to play. Okay, so the more you trade options with the higher probability, okay, the chances for you to win is very high. Even though, okay, let's say you got 10 trade, okay, even you got 10 trade, let's say you only win 5 trade, okay, lost 5 trade, okay, by right you will think, in that case, it's like 50-50, I don't make, I don't lose. No, not really, because your probability of winning is very high. You get me or not? Okay, so when your probability of winning is very, very high, okay, basically, the more you play, okay, the more you can make money in the long term. You get me or not? Of course, we cannot see it like in a 1 or 2 weeks time. Okay, if you put a day, do a day trade, you get me or not? Okay, so this thing we're going to discuss later on. Okay, so after we understand implied volatility, okay, the next one, very important, equally important also, is called the Greeks lah. I don't know why they name it the Greeks lah. This is actually based on the Black Shoes theory, okay, which actually the guy who created the options pricing. Okay, so the Greeks will tell that an option price is expected to change when certain variable like time, very important, the stop price, yes, delta, okay, and the IV, okay, the IV we just learned, okay, the implied volatility change, okay. So now you know what is delta, what is gamma, what is delta, okay. Delta, we look at delta first, okay, it's the option expected price change when $1 of the stock price change. Okay, now is okay, I give you a very good example here. Okay, we go back to the handy trader. Okay, at least you guys can read. Hold on, I think we can using the web also lah. Okay. Okay, you look at we look at the market is not open yet. If the market open already, we can see the directly the IV here. Okay. Okay, guys, you log into your handy traders. Okay, you look at you click any options. Okay. Apple. Okay, let's say you want to click Apple, you can click Apple. Okay. And then you can choose any options you want. Okay. Okay. I give you an example. Okay. I think you hold on for a while. Cancel. Okay. So basically, if you look at handy trader, you look at delta here. What is the meaning of 0.2 here? Okay, this option is going to expire tomorrow. Okay, and the price is out of the money a lot because now Apple price is 112. It's $5 out of the money. Okay, so that's why the delta is a bit low. Okay, meaning that today price, if let's say Apple stock go up from 112 to 113, how much this option will go up? Anyone can answer me? Are you guys sleeping already or what?
Vimal here 0.22.
0.22.
Delta.
No, what I mean here is, okay, if today, okay, Apple stock, assume now Apple stock is, what's the price of Apple stock now? Okay, it's 112. Assume that tonight Apple stock go up to 113. What happened to the option price? Because this is a very important element, you know.
This is a call. A call.
Okay, what is delta first? Delta meaning that every $1 the price change, okay, the option price will equal that value. Okay, meaning that if Apple from 112 to 113, okay, meaning that, okay, $1 Apple go up, the option price will go up 22 cents. Okay, because the delta here is 0.221 or 22 cents. Okay, meaning that if tonight Apple stock go up to 113, okay, the options price here, okay, will be 1.23. Okay, because 1.01 plus 1.22, 1.01 plus 0.22. Okay, so you will get roughly 20% return. That's why people say, wow, why you see options so high return? Okay, you know what I mean? Okay, so today, if you think tonight before the market open, right? Okay, but options market only open, okay, at 9:30. Okay, so basically, if option market open, still the same price like this. Okay, what happened? If you think Apple stock tonight will chiong one lah, you know, will go up like hell one because of earning is tomorrow. Okay, so you buy in the options of 1.01. If Apple stock really go up to 117 tonight, go up $5 tonight. Congratulations lah. Why? You can using $5 time, okay, 0.22. Okay, so you will get 100% return tomorrow morning. Okay, so tomorrow morning US time, tomorrow night, when the market open, you can quickly sell it already. You can sell it at the market directly before the implied volatility collapse. Okay, you get me or not? Okay. Okay, so this is assumed delta, but of course, the $5 thing I don't want to mention. I mean $1 first, because the $5 thing is going to impact by the gamma also. Okay, gamma actually is every dollars change of the delta, okay, rate, okay. Okay, I ask you guys another questions, okay, to make sure that you guys really understand lah, okay. Okay, okay, let's say now we choose an option now. We don't want to choose tomorrow one lah. We're going to choose we're going to choose 1 month later one lah. Okay, 1 month later one. Okay,
Mike, Jimmy here. Can I ask one question first?
yeah. Go ahead.
Let's say this one, you say every $1 based on data, the delta is 0.222 based on the example for Apple. What happens if it doesn't go up $1, it just go up by 50
The
cents?
ratio. All is a ratio game.
Based on ratio. So, okay, thank you.
Exactly.
Okay.
It's easy for me to choose the delta 0.5 lah, to be very frank. Okay. Then you guys will get it very easy. Okay. Let's say we look at AMD expiring November 20. Okay. Higher. Okay. And then wow, the premium is very, very high. Okay. Let's see. Okay. You look at the delta is 0.54. Okay. 0.5. Let's say, wow, shock. Okay. Okay. You buy in now because this is in the money. Assume other all equal. Okay. Okay. Because options are determined by implied volatility also. Okay. So basically, but delta normally I like to using delta for day trading. Other thing I not really see like because not really impact a lot. Okay. If you know, okay, because day trading, you know, to 19 minutes you can go up already, or tomorrow you can go up already, you know, the kind of thing, you know, you don't hold more than 2-3 days one. Okay, sometimes also is, you know, if really the thing is right, okay, sometimes options if the thing is really follow you, you chow one already, especially when you buy the call, you know, okay, because you don't want to impact by the decay of the time. Okay, so basically let's say 1 month later, 1 month options from okay, look at the contract. This is November 20. Okay, it's almost like 1 month from now, 3 weeks from now. Okay, let's say AMD go up. Okay, now AMD price is what? Let me see. Okay, okay, AMD price is $76. Let's say $76.50. Okay, so we buy in the money. Okay, in the money options. Okay, we buy the call. Okay. Okay, so you know, okay, so basically when you look at it, okay, you see okay, just now where is it? Where is just now the view? Okay, buy, okay. Yeah, I think got delta also, right? Okay, the delta is 54% lah. Okay, just now they don't using, okay. This is percent, you know, so we say 54% or 0.54 lah. Okay, meaning that every dollar AMD go up, the options price will go up 54 cents. Okay, or 55 cents. Okay, you know what I mean? Okay, let's say tomorrow, okay, AMD go up to even tonight also like possible one. Okay, tonight, okay, AMD go up to what do you call it, to $77. Others thing all equal. You must remember options you have to using this word, other things all equal, you know. Okay, because not only delta impact the price only, but delta normally impact a lot the price near the near the expiration one. That's why I like to trade day trading for the weekly options or daily options. I just by looking at the delta only. All right. Okay. Okay, so we can roughly know that how much we earn already if this stock go up to $1, okay, or $2. Okay, $2 have to impact by the gamma already. Okay, but normally we just roughly estimate lah. Okay, so basically if now my question here is, okay, one by one answer me lah. Okay, we start from who first because or else I don't want you guys to apa ni. Okay, we start we start with Alan first. Okay, Alan, if tonight, okay, what do you call it? AMD go up to $77. How much I make if I buy this call option?
By $1.50, you make you make 50, so you make 50 cent. So you
By
make 50
$1.
cent. So you make 50 cent.
54 cent lah. Okay. So
4
basically,
cents.
I will make 54 cent lah. Okay. You get me or not? Okay. 55 cent lah. 54 cent 0.717 lah. You see or not? Okay. You get or not? Okay. So yeah, good. Okay. Okay. Felix, how are you, Felix? Are you there?
Yes.
Okay. Okay. If let's say we choose another options again lah. Okay. We go it one by one. Okay. Okay, I think there's something wrong with AMD. If I think something wrong with AMD, I think AMD will go down. Okay. So basically I buy, okay, the put, okay, in the money also. Okay. You look at the delta, okay, because the delta actually is lower than the buy, the call. Okay, it's only about 44% only. Okay, because the delta for the put is always negative one. Okay, just remember that. Just remember this only. Okay, so just forget about the negative sign. Okay, look at the 45%. Okay, so if AMD tomorrow go tonight go up $1, how much do I make money or not if I buy this put? If AMD go down the price $1 tonight,
Yes, Sumek.
yes, how much I'm making?
$1 minus, assuming that is a 45 cents, so that would be 65 cents, right?
Why 65 cents? Actually, it's very simple only. You look at the delta, okay, basically you just times the, okay, times the $1 only, okay, so it's actually the percentage, it's actually, I'm actually making 45 cents, correct lah, 45 cents, you get that? Okay, so 45 cents I will make, assume all other equal, all right, okay, so I will make 45 cents, okay, 45 cents of $4 is how much? Okay, Jackson, how many percent I make in terms of percentage?
You mean the delta, is it?
No. Overall, how much I make if let's say tonight AMD go down $1. Okay, if I
45
buy this
cents.
delta, huh?
45 cents.
Yeah, 45 cents is the value I make, right? I just asked what's the percentage? More
Percentage.
than 10% lah. Easily more than 10% lah, correct or not?
Yeah,
Okay.
correct.
Okay. So that's the reason I tell you why option actually if you really a good option trader, right? Okay. You can, if you really can forecast the stock price lah, okay, so you can use this to make very fast money. All right, Hakim, are you there, Hakim?
Yes.
Hakim, do you understand what is actually delta and how do you read it? How do you going to determine the price going up or going down to help you to make money?
Price changing on the let's say call option is $4. $1 will change 45 cents.
Yeah, assume let's say this is a put lah, okay, assume this is a put. If the price go down $1, okay, you will make, okay, 45 cents. If the price go up, you will lose 45 cents. You know what I mean or not?
Yes.
Simple as that only. Yeah, so that is a very important element when you look at the option I call it option data lah, okay. The delta is very, very important, and this is the one normally I make, the one I show you guys, you know, wow, 15 minutes make how much, I just refer to delta only, okay. Okay, and it's quite accurate. Normally, I would say the accuracy is 80 to 90% of the estimate price that I can make. Okay, so if you buy deep in the money, of course, the delta is higher. All right, okay, this is Jimmy. You still remember you asked me the question, Jimmy? Okay, you asked me the questions, why we want to buy deep, why we don't want to buy deep in the money. Yes, you can buy deep in the money. Okay, why? Because as deep as the money go down, okay, the delta will be getting higher, meaning that every dollar go up, the stock, not necessarily every dollar go up on your option price one, you know. Okay, no such thing one, unless that one is, even there is 99%, that one is very, very, very deep in the money lah. Okay, they want no more in extrinsic value already. Most of them are already fully 100% intrinsic value already. All right.
Okay.
You understand already, right, Jimmy? Okay.
Yes. For
Okay.
Mike, actually, based on that, the meaning, we look at if we want to trade, the higher the IV is better to trade, like there's more volatility, then give us more range on this, on it to play around. Does it mean like that?
Not necessary also. It's depend on the price way the futures price go, Okay. Okay. If the volatility sometimes can be collapsed after the things people expected not happen, This is called the crush of the IV. And it normally happen after earning one, because after earning everybody know already. Okay. So basically that's why if you think that you want to trade before the earning, let's say like tonight 350 before the market close, okay, you can buy long call and long put. That's called a buy trader, okay, which we're going to learn tomorrow. Okay, so basically if you buy trader, okay, because you think the IV is very high and you're going to go one side, both side, yeah, possible. So we don't know, because we don't know the future price of the stock. If we know, okay, we're going to be very, very rich by playing option, because option can amplify your return. You know what I mean or not? Okay.
Yes, Mike. What I mean is that, is it because of the higher IV, it gives us more comfort that to trade, because the range I look at it is
You want to buy or you want to sell?
wider.
You want to buy or you
I would say call for call option.
want to buy call lah?
Yeah.
Okay. And like I say, history showing that okay, buying call and buying put especially out of the money is like gambling. Okay, because your probability is less than 30%. We're going to study that later. Out of the money. In the money, you may still got hope because you got intrinsic value there. You get me or not? However, if let's say the price go against you, okay, you still will have some money, but the one you lost is only intrinsic value you lost, not like kaput everything. But if extrinsic, you only depend on extrinsic value, okay, basically that is a bit I would call it a bit gambling lah, because your probability is less than maybe 20-30%. So don't worry about it. Every time you want to buy, okay, you can see the probability. But of course, if you really certain know something that think for sure, okay, will happen one, right? You can like buy 4D lah. At least this is better than 4D. You get me or not?
Yeah.
You know me or not?
Yeah.
4D, your probability is nine. You buy one 4D is 9,999. You get me or not? Okay, this one no, this one at least you still have a 30%, 40% of chance, but if you really pick up, you can earn 100%, few 100%, just like the Facebook stock I share with you guys one. You get me or not? Okay, that's actually out of the money, okay, because it's very cheap. So I buy it at I actually using a cost spread to buy it one. Okay? So basically the 45 cent 47 cent when you pick up to $1.45, right, you can actually make how much? Okay, almost like 1,000% there. You get me? Possible, you get me or not?
So Mike, to summarize before you continue to the next slide, to summarize on what you said earlier on, so would be better to it will be better to trade before the earnings, because it's better, the result haven't out, so all the expectations there.
That one I agree. Okay. Normally, if you want to be a more conservative side, okay, normally trade before and after the trading, the earning, not through the earning. Okay, if through the earning, you take the risk lah, but of course the return can be very high lah.
Thanks. Yeah, thank you.
Okay.
Got it.
Good questions. Anybody? Okay.
Yeah, just how you said delta, you always look at the delta. What does the delta tell us? I mean, how do you use the delta to make decisions whether to go for the
delta? Yes, delta is the one who to tell us when every dollar the stock price move, delta will move at that percentage. Let's say the delta is 0.5. Okay, meaning that okay, $1 the stock go up, your option price will go up 50 cents. You know what I mean?
Okay, so you want higher delta, then got more promising.
Yeah, possible. Okay, you want to good the higher delta, okay, of course, but if you go down, you also lost more. That's why I say the option is all depend on, okay, whether you are right on the stock price go up and go down. So I will guide yourself. How I will teach yourself how to determine the range. Now you know already why every day I send your guys the range or not. Okay, because normally that range, okay, if you go down to the bottom already, you can buy it. Okay, okay, you can buy in the money. Okay, so normally when it bounce back, okay, even like 50 cents or $1, you already can make 25% to 50% already for $1 of the stock price, the option price. You get what I mean?
Yeah, yeah, yeah.
Very,
Milo. Yeah.
Yes, Mike. Thanks.
very good, very good, very
Thank
good.
you.
Yeah.
Mike Shim here. So the range can be day when you share in the group,
Yes,
can
yes.
be week, can be month.
Correct.
So are you looking at that the to determine the range? You are looking at the implied volatility. I mean volatility.
Volatility. Okay.
Volatility.
The basically the implied volatility is not really to saying that the range lah. Okay. The to determine the so-called the range lah. Okay. What determine the range here is they call it just now there's a formula there, the stock price time IV. Okay, and then time actually later on. Okay, I will actually give your guys okay, now you can see this because okay, you look at it as okay, okay, this is a formula actually how you determine the range. Okay, you were actually using a price times the IV. Okay, and then times the square root. Okay, let's say 2 days. Okay, you have to using the square root. Okay, there's a formula lah. Okay, square root and then 2 divided by 362. Okay, and then you get a range. Okay, and the price always change one also. No, okay, okay. Now the price is already 76.97 already, but not. Of course, we are not high frequency trading. Normally, okay, basically, this is the prices actually 5 o'clock just now when I do pre-market price. You get me or not? Okay, so basically, if the day low highs, if you guys have time, you guys see, oh, day low price 来了. Okay, so basically you actually can determine in the money, let's say we say in the money options, we buy that moment and the delta is 0.5. Normally it's 0.5, 0.6 lah. Okay, 0.4 to 0.6 lah. Okay, we say 0.5. Okay, so if the option price, let's say is $1, okay, the delta basically, let's say is a 0.5. Okay, so if AMD go up to $1 from the day low, it go up to $75. Okay, your options, okay, will become 1.50. So you are buta, okay, packing 50% return just by maybe about half day, or maybe sometime only 5 minutes, 10 minutes, like what I show you guys, in the options, I mean the advertisement there. Okay, there's a real one, you get me or not? Okay, so now you know how I make money already, right? Hello.
Yes, Mike.
Yes. Yeah.
Yes.
Yes, yes.
Beside others, okay, if you don't know, you have to ask, okay, because I want everybody can make money and then try this, okay, and then really make money, okay, then happy lah, okay, then you can become a day trader. Okay, options, if you really know how, okay, become a day traders. Actually, I tell you already, okay, because of the probability of success, okay, it's on your side. Okay, sometimes you will lost definitely one. You cannot be like 10, you 10 trade, you lost, you win 10 trade one. Okay, but the higher probability on your side, right? Okay, even you win 50-50, right? Okay, you still win one. All right. Okay, so, and it's very rewarding if you have time. Okay, if you don't have time, maybe you can set also. Okay, you roughly know this is a day low price, and then in the money option is how much. Okay, you set that price and then take profit how much. Okay, you can set. Okay, so you look at the delta, maybe 0.5. Those delta very, very low one, you don't go in lah. Okay, but cannot say also, because sometimes the implied volatility suddenly spike. Okay, then you don't blame me lah. Okay, I just let you know that we choose the higher probability only. Okay, you know what I mean? Okay, we choose on the statistic. the higher probability. Okay, the market is open now. Okay, let me take a look at the market. So you understand or not how you're going to make money by using a delta? Okay, this is a delta. Okay, this is before. This is after. Assume now we buy at $74 at day low. After the price is $75. Okay, so this is the stock price. Okay, this is option price. Everyone, boleh?
Boleh.
Bagus.
Boleh. Okay.
Okay,
Okay.
Zima, okay, Zino, okay, Zino.
Yes, yes.
Very good, very good. Okay, I honestly speaking lah, I believe this group is all smart one lah. Else you guys won't come in lah. You get me or not? Okay, because you guys understand option 101 already. Some of them I ask them, they say they don't understand 101 yet. You get me or not? Okay, so good. Okay, so I will continue the next slide. Okay. Okay. Okay, now we look at gamma. Okay, gamma actually are not really unless the stock really push up a lot. Like gamma is like a speed, you know. Okay, like we're using no, sorry, gamma is like accelerations. Okay, delta is like a speed. Okay, or I using DM here. Delta itu adalah kelajuan. Okay, gamma itu adalah pancutan. Okay, you get me or not? Okay, meaning that gamma actually is every dollar. Okay, the delta price, okay, change. Okay, the just now we look at delta, right? Is every dollar, okay, it go up. Very simple to determine. Okay, now actually gamma is every dollars another the next dollar, the second dollar. Okay, so if the price has suddenly strike, right? Okay, gamma will help a lot. Okay, I show you why how. Okay, or delta, I think everybody understand already. Okay, no need to explain already. Okay, so delta, I think you know lah, right? When the stock price $1, okay, 50 cents. Just now I illustrate for you guys one. Okay, okay. So go down. Okay, if let's say if you know this is actually a call options lah. Okay, if go down you lost money lah. If go up you make money lah. Okay. Okay. Okay, understand, okay, put options, okay, if you know, this is a put options, yeah, okay, the price go up, okay, sometime actually this chart, okay, never mind. Okay, now we look at gamma. Okay, gamma normally will be positive lah. Okay, why? Okay, because you know, we look at this illustration is easier lah. Okay, okay, gamma is the second dollar. Okay, just now the first dollar, the second dollar, okay, will actually determine the gamma. Okay, for example, I give you an example. The first option price is $5, okay, 50 cents you make, okay, with the delta of, okay, 0.5. Okay, so the second dollar, okay, is 0.5. Okay, you have to plus 0.1 here. Okay, and the total gamma here is actually 0.6. So meaning that if let's say the second dollar, okay, it go up, right? Okay, you are not really like making 50 cent anymore. You are making 60 cent anymore. Okay, so that's why I say just now kelajuan and what do you call it? Pecutan. Okay, you hold on for a while. Let me plug in the thing. The what do you call it? So gamma is not really that important, to be very frank, especially when you play daily options or weekly options. Okay, unless the price is a super. I mean the volatility is a super high lah. Okay, so basically gamma will help you to gain more in options. All right. Okay, because the second dollar, okay, it will actually your gamma will increase. Okay, that means your second the second dollar it go up, right? You are not making 50 cent anymore. You are making 60 cent already. You get me or not? Okay, so this is actually a gamma. All right. Okay. So when you look at the gamma, you will roughly know. Okay. Let's say it put there 0.1, meaning that the second dollar is okay 60 cent you make already. Okay. And then if you go up to $3 and again, there's a formula there. Okay, you make more already. Okay. So basically, if suddenly the stock go up $5, push up like hell. Okay, gamma. Okay, will help a lot. Okay, beside the delta. All right. So this is gamma. All right. Okay, so basically, let's say I seldom look at gamma because it's very small lah. Okay, the figure. All right. So the put option is the balik lah. Same also. All right. Okay. So basically, if like you say let's say you look at the options of the delta is for put normally is negative. Okay. So basically gamma is 0.5, but you don't look at the negative lah. Don't look at the sign. Okay. Oh, so 0.4 plus 0.15, okay, the gamma there. Okay, so basically the next dollar, okay, you actually were making 70 cent already. Okay, not 55 cent anymore. All right, because you're using 55 cent plus the 15 cent. All right. Okay, so now we look at theta. This is a very important element. It's the most easiest. It's the most easiest Greeks to understand. Okay. Is the price will decrease with the passing of one day. Okay, so people say, okay, if you are an option seller, you like theta a lot. Theta is your best friend. Okay, if you are buying option, theta is your worst enemy. Okay, provide other all equals lah. Okay, you get me or not? Okay, especially let's say you buy those stock are not high volatility one. Theta, you selling the theta is your good friend. Are you selling the option? Theta will be your good friend. So at the expirations, okay, the options only have intrinsic value. Okay, meaning that the extrinsic value all gone already. Okay, so thank you very much if you are a seller. Why? Because you collected all the premium already. All right. Okay. So basically, theta is very easy to understand. Okay. Now you look at your handy trader. Okay. So basically, when you look at your handy traders, okay, you can look at the theta. Okay. I give you an example here. Okay. Because I don't want to using Apple because Apple tomorrow is a what you call it, tomorrow is a earning tomorrow morning. Okay, so it's not really that accurate lah because the event okay make the others all these Greeks it's not really accurate. Okay, okay, let me see. You hold on for a while. We look at AMD again. Okay, 77. Okay, guys, I tried to put in the zoom in again. Okay, guys. Okay, you look at the AMD 1 month from now again. Okay, not 1 month, actually 2 weeks from now. 3 weeks lah. 3 weeks from now. Okay, November 20th. Okay, 77 call. Okay, we look at theta because we are studying theta now. Okay, it's negative. Theta always negative one because every day it passed by, one day it passed by. Okay, this value will gone, will gone, will gone. It's just like dripping, Okay, again, it's just like the ice melting, Okay, okay. So basically, the ice melting is if you are seller of the option, you actually just like a cup, get the water, come here, you know what I mean or not? Okay, so basically, theta is always a good friend for seller, for option seller or writer. Okay, so every time you look at this option price, $3.60, provide other thing all equal. Every day, the value of this option because of theta, we're losing 12 cents, about 11 cents, 12 cents lah, 119 lah. You get me or not? Okay. Okay. So if you look back, provide all other equal. Okay. You can see as the option price, the day pass, the option price will tuk, 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 tuk. So As a seller, you want this thing happen because you are collecting the 10 cent, you know, every day you collect 10 cent, 10 cent, 10 cent, 10 cent like that. Okay. If nothing happened to this stock, you know, you get me? If not really a high, no, the IV is not high, no spike of this stock, this and that. Okay. So I normally like data, okay, when I sell options out of the money, okay, because it's easier to collect, okay, you know, not okay, especially near the expiring date, okay, because like I say, you want the highest probability. At the same time, also you want to have more, you know, you have more trade, higher probability. The edge for you to win is very very high, okay, for you to make money. Understand, Teta? All sleeping already?
Okay.
Okay, yeah. Other?
Yes. Okay, okay.
Okay.
Everyone understand, huh?
Okay, okay.
Okay, okay. But I think your guys are maybe type the chat there say yes, yes lah. Okay, okay. Then only I see whether your guy really understand or not. Okay, because we still another 45 minutes. Okay, because why I spend a lot of times. Okay, in uh, explain all this is because this is very very important. Okay, it's very important. Okay, yeah, okay. Zeno, okay. Tan, okay, good. Nesh, okay. Hakim, are you okay, Hakim? Boleh? Ellen, okay, Hakim, okay, okay. Good, good, good. Okay, so you just stop me, you know. I tell you already, I don't want people, I don't want you to play buta buta, come here and learn nothing one. Okay? You see or not? Okay? So very important, very important. Okay, good. If understand, then we go to the next slide. What is next slide? Okay, Vega. Vega actually is honestly speaking, you talk about Vega, right? Okay, it's very related to implied volatility. Okay, because option price change the implied volatility. Implied volatility will determine the value of Vega. Okay, so basically, the higher the Vega normally, the normal sense here is okay. The higher the Vega, okay, the higher the implied volatility, okay, and then the longer the options will be expiring. Okay, so basically, it related heavily to the implied volatility. Okay, when option price become more expensive, they have more extrinsic value. So implied volatility increase. Okay, when option price become cheaper, less extrinsic value. Okay, so Vega express how much the option price is expected to change with each percent change of the implied volatility. Okay, so the most important thing you must know here is the option price change first. Okay, because why? Because of demand and the supply. Okay, when the option price change, okay, increase, okay, let's say 1%, okay, then you can see the Vega have 0.25. Okay, if let's say the option price decrease, okay, 1%, expected 1% of the implied volatility, then you can see, okay, the Vega, okay, will be 0.25, okay, decrease, meaning that the implied volatility will minus 1%. Okay, so remember delta is $1 each time the stock price change, whether go up or go down. Okay, but for Vega is each time the implied volatility change. Okay, but the implied volatility change is because of the option price change first. Okay, so then it will determine the Vega. All right. Okay, I reverse back the implied volatility things, okay, because the implied volatility is the most is a very important element, okay, in this options cost. However, I just want to let you know also implied volatility is the most difficult for us to determine one. Okay, even we have like implied volatility rank, okay, we have implied volatility percentile, okay, but however, that is actually it's not fixed one. Okay, why? Is because option price is always changed, okay, based on the expectations of the buyer and the seller. Okay, we just can say, oh, we will, it just give us the indication only. Okay, other thing like delta is the number there is quite fixed one. Okay, So basically, theta is very easy. Okay, every day go by how much the options we're losing the value. Okay, so option basically is something like it's not a valuable asset lah. In fact, actually, option is not an asset at all. To be very very frank, okay, option is a speculations tool. Okay, and then for hedging also. Okay, for people to worry. Okay, what if market crash? How to make money from market when market crash and market go up. Okay. Suddenly it won't go up. Okay. So okay, this one I already I repeat again because I just want you guys know what is the implied volatility. Okay, and then we look at Vega back again. Okay. So assume, okay, all other thing equal, okay, at the money Vega, you can see that, okay, let's say 225, it's a 200 something like that. Okay, let's say this is an option price of around 210 lah, let's say 20205 lah. Okay, you can see, okay, this is actually a bell curve lah. Okay, you can see the longer, okay, that to expirations, okay, the higher the Vega. Okay, meaning that why? The higher the extrinsic value lah. Okay, because of the uncertainty. Okay, so the shorter, okay, the date to expiring, okay, the lower the Vega. Okay, why? Because the risk is getting less already because the day is approaching to the expiration date already. Okay, so higher extrinsic value equal to higher Vega. Okay, so that's all. Okay, guy. Okay, so we still have about half an hour. Okay, so how are we going to profit from long call and long put in a day trade? Okay. Normally, I don't know. Maybe I'm a guy who like to long stock. Okay, so long, because when I choose a stock, okay, I have to make sure that stock is a very healthy stock. You know what I mean or not? Because when we play stock options, it's all depend on the stock that we choose, except this 1-2 weeks. This 1-2 weeks is because of the event like president elections and the earnings season. Okay. Or else, for me personally, okay, I would like to choose the stock that a very good one. Okay, meaning good one, they have a very good FA. Okay, meaning that they have a very good financial analysis. Okay, so basically, why? Okay, because if I'm wrong in the options, I can still be right in the stock and I still can make money. You know what I mean or not? Okay, okay. However, okay, if tomorrow we're going to touch, okay, how are we going to collect premium if we have a good stock? Okay, the stock like Apple, the stock like Facebook, okay, the stock like AMD is a bit volatile lah. Okay, so AMD I believe is good also, even the PE is a bit high. Okay, and any stock that you know the nature of it. Okay, so the moment you know the range, okay, you can actually use it to collect rental. Okay, that one tomorrow we're going to discuss. Okay, and also you can buy the stock at the lower price. Okay, if you think the stock is very high now, and also collect premium. Okay, that's a good thing about options. So, but okay, if you want to do a day trade one, we are not saying collecting premium. We are talking about paying premium. Number one, you find the high beta stock. When I say high beta stock, don't too high lah. Okay, the very, very high one like Roku, that one you got heart attack lah. Then you need a big capital also. Okay, however, Roku, I can tell you, wow. Okay, those no, high beta meaning that actually is very, very volatile. Okay, I give you an example here. Okay, it's very good questions. Okay, PNG, you can see. Okay, look at Disney lah. Okay, but now all the beta very high because of the coronavirus. Okay, Okay, never mind. We'll look at this Disney. Okay, look at the beta is 1.10. Okay. Disney used to be the data is, I think, is around one actually is compared to this compared to apa nama ni, compared to SPY. Okay, the standard and poor 500. Okay, I give you one stock that I tried before. This stock can give you a heart attack one if you don't know how to play with it, but you can make a lot of money also. You look at the beta, it's 1.79. Okay, it's 1.79. Okay, so this is a very high beta stock. Okay, now we look at AMD. $2.29. Okay, meaning that, okay, every, the probability, it is the percentage is 1.29 higher, the fluctuations, okay, the volatility is higher than the SPY or S&P 500, meaning that, okay, the higher the beta, the more volatile it is. You see, AMD already go up $1.55 while we are talking. All right, so just now, if you buy $76, right? Like I tell you one, no? You make already, no? You get me or not? Okay, so this is how the result just now I show you guys one lah. Okay, you hold on for a while. Let me see because I think I lost some code there. I want to get out already. Yeah, okay, I have November 6, 79.5 call. Okay, still got 1 week to go, so I understand this stock well. So I still losing. Okay, but today I'm making about $56. Okay, because of yesterday, bloody hell, market go down a lot. Okay, I show you guys. Okay, AMD. You hold on for a while. Okay, I buy 1 week expiring date for AMD. Okay, this one is collect income lah. Okay, you see AMD November 6 next week expiring. Okay, so basically I buy it at $2.79. Okay, today I'm making $57, but because of yesterday, the price, the whole market collapse. Okay, so I'm actually losing yesterday. Overall, I still losing because yesterday I lose, but today I make. So if today it go up to $1, okay, I already making another 50 cents already. Okay, so basically, when you look at this stock, okay, you look at the delta. Okay, the delta is not really that high yet, but it's good enough already, about 44%. The profit probability actually is 31% only. Okay, why? Because I'm buying. Okay, I'm buying the call. Okay, so the profit probability is lower. However, because I know this stock have a high, the IV is very high. Okay, you look at the implied volatility. Okay, it's very high. Okay, so basically, I go into this stock. Okay, so basically, this is how if tonight it go up to $2, okay, the delta of this stock is the delta. Where is the delta? Are there the delta? Okay, the delta, okay, is about 0.44. So if you go up to, let's say, assume gamma not really impact a lot lah. Let's say 0.5 lah. Okay, so let's say it go down $2, AMD will go up. Let's say tonight the stock go up to $2. Okay, almost there already. Okay, so basically because this is out of the money a bit already, okay, what I mean is in the money, because the time I buy, the time is still in the money, because my assumption is during that period of time AMD will go up. Okay, however, because of last night event, it go down, but tonight it pull back. Let's say this trend continue to pull up tomorrow. Okay, so once it in the money, okay, if it go up every dollar, I will making about 50 cents already. Okay, so basically if it go up $2, I'm making $1 already. So I put in $2.79. Okay, so if it go up to $1, I'm making how many percent already? A lot already. All right, okay, it's almost 20 to 30% already. All right, guys. Okay, so this is how I trade AMD. All right, AMD actually I recently only 2-3 weeks only I trade only. Okay, before that I like to trade Apple. However, Apple, because of near the earning this 1-2 weeks, so I don't really look at Apple. Okay, for Apple side, Apple I hold the stock about 200. Okay, so basically what I do here is it go down a lot also, but my call I using a cover call. Okay, so basically the cover call already give me the rental of how much already, $99 already. Okay, so as long as tonight after the event, after the earning event, it don't go more than 117. Okay, I will collected about 400 rental. Okay, okay. So even if it go more than that, don't worry. Okay, because I got stock to cover. So this is called cover call. Okay, this is the one tomorrow we're going to mention how you collect a rental. Okay, so cover call definitely is a winning game, sure win one. Okay, in terms of options, premium you collected. Okay, okay, either is you make more or you earn make less only. Okay, that is a cover call options. Okay, you sure can get the premium one. Okay, so how good is it? Option, right? Okay, so understand, guys?
Yes.
Yes, Mike. Thanks.
Happy, yeah. Bank in tomorrow. No lah, you bank in for after the election lah. Okay, everyone understand or not? Okay, you get or not? Okay, so it's not that difficult. Okay, I believe all of you are very, very smart. Okay, so very easy for me to explain. Okay, so once you understand all these Greeks, okay, once you understand the implied volatility, okay, I can tell you, okay, and you can choose stock that you like to play. Actually, the stock I already share with you already. Okay, AMD, like Micron, I think is good also. Okay, normally it's tech stock lah. Okay,
What about Facebook, Mike?
Facebook, yeah, Facebook because of but Facebook premium is very high is because of because of apa namanya, because of the share price is very high. You look at the percentage actually better. Okay, okay, FB is good also. Okay, let's say FB. Okay, what's FB price now? So today the market is very buoyant. 277. Okay, I also trade Facebook. Okay, let's say Facebook. Let me show you the thing first. Facebook, I hope it stopped at 280. Okay, if stop at 280, I collected 2,000 bulat. Okay, but tonight I think very difficult lah because of the earning season. Okay, you look at Facebook. Okay, so Facebook tonight I'm making about, okay, because the stock bounce back lah. Okay, so I short the put. Okay, so basically okay, I short the put. Okay, the put is recovering already for tomorrow, for yesterday night. Okay, so basically I'm making money already. Okay, I'm making about $52 already. Okay, so basically the profit of the put today is about 600 something, $634. All right, and then I short the call also. Okay, and then the call definitely I think will be making money lah. Okay, so I'm making about 247 already. Overall I'm making 255 already. Okay, because today the market go up, so the put value, okay, go up, so it will be a negative. All right, okay, so this is however also this call actually has been protected by the stock. Okay, so again I form another strategy here called cover call. All right, so I have 100 share of Facebook. Okay, so for Tesla basically used to be a very, very high beta. Okay, but however the IV collapsed recently. I don't know why. In terms of percentage, okay, maybe the sexy story of Tesla already passed already. You get me or not? Okay, so basically this is how you can. Okay, if your guys cannot you guys want to start small all these things first okay, what you guys can do actually tomorrow I will guide your guy how to using spread to make some pocket money. Okay, so to trade this kind of account size, minimum you need about 30 to 40,000. All right, okay, to have, because of I mean, of course depend on the stock you choose also lah, because of when you trade you want to become a day traders, okay, you cannot fall under this so-called day trading patterns, okay, which actually occur by this sorry, which actually regulated by this security exchange US. Okay, so minimum, let's say you want to become a day trader, meaning that the same instruments, unless you're using different instrument, if the same instrument, okay, you buy in and buy out, right? Okay, if you more than 3 times, right, your accounts will be automatically you cannot buy anymore. You only can close the position on it, unless you have a value of more than 30,000. Actually it's 25 lah, but I will encourage you put in 30,000. Okay, because of why? Because by then, okay, at least you have 5,000 buffer. Because as long as you fall below 25,000, the system will automatically, if you trade 3 times, okay, in 1 week row, okay, the same instrument. I mean, day trader meaning that today you go in, today you go out also. Okay, so the system will automatically buy you for buying already. You only can close the position. However, don't worry, okay, you even can start with 2,000, okay, 1,000, 2,000, or 3,000. Okay, so when you start with a smaller value, okay, what you do here is we were using other strategy, okay, which tomorrow we're going to touch lah. Okay, this is more on a spread strategy. Okay, so or you can actually naked long call or naked long put. Okay, like what I teach your guy, I guide your guy to I share with your guys today. Okay, so if you with a small amount of money, you can long call and long put anytime. Okay, you know what I mean? Okay, so what you do here is, okay, you actually can find a high beta stock. You can long in the money call or dip in the money call or put. Okay, using a day high, day low chart to increase the profit, the PP, the profit probability. Okay, so the day high, day low, I already tell you already, that's a range lah. Okay, and you're using a very they quite fast in, fast out lah. Okay, because you are long the options, you know, so you don't want times against you. So as long as you have 25 to 50% return, cabut lah. You get me or not? Okay. However, if let's say you know, if you know the stock very well, okay, maybe you can you know, because as one day pass, you will lost your data. Okay, so the pro side of this trade is you can have a very fast return. Okay, this kind of return like I show you, I show in the teaser one lah. Okay, where you can go in. If you are right, tomorrow you can get out already, or you go in today, you can get out already. Okay, and a very fast return. Of course, the negative side, if the direction is wrong. Okay, so if you're wrong directions, if you think you want to cut, you can cut already also. Okay, so a lot of people who are very good, who are long enough in options one, they won't using cut loss this word one. Because normally the premium you pay is considered is a cut loss already. Okay, or if you sayang lah, okay, then maybe you can put 50% of the premium you pay. Meaning that if the premium decay or lost value around 50%, you cut already. Okay, this is all up to your expectations and all up to your how much money you put in and how is your risk management. Okay, so the 2001, okay, US dollar that you put into play options, bear that in mind. I just to let you know that is only considered as 1% of your or 2% of your 50,000 account. Just assume that you have 50,000 account lah, or 40,000 account lah. Okay, so the 2,000 basically is what you can do here is actually you can use it to practice. Okay, you get me or not? Okay, but like I tell you, if you really discipline, okay, and because the probability is on our side, okay, I tell you already, we trade the higher probability. Okay, so when you trade a higher probability, you can using a day high and day low to going in and going out fast. Okay, so of course you say possible lost money or not? Possible. Definitely they have 2-3 bad apples one out of the 10 apples. Okay, however that like I tell you already, if your risk and reward is equal the same, okay, even 2-3 bad apples out of 10 trades, okay, you're still making money. Okay, so it's all depend how you manage it. Okay, so don't try to think, okay, this 2,000 or 3,000, you know, it's going to make you a lot of money already. No, use it by a percentage. Okay, try to using a long call, long put, and using this strategy first. Okay, and then when you make a bit money, okay, like even you, let's say the premium is $100, $150. Okay, if you make $15, is considered 10% already. You know what I mean or not? Okay, always using percentage. Okay, when you start small, if you can make money, I'm very sure when you grow big, you can already. Don't try to say, oh, I want to start big first. Okay, because when you start big, right? Okay, you if you cannot make money in a small account, right? Don't try to think that you can make money in a big account. No way one. Okay, this is psychology. So always assume that return is based on the percentage, not based on the dollar value. Because sometimes I say, ayo, I only making $15 per day, minus the commissions, the commission in out almost $10. For option is higher a bit. I just let you know. Okay. So basically it's about $4.95. It's higher a bit than this, but the return is definitely is fast. Okay. So basically you need to make $20. Let's say make $20. Okay. Then basically, or $30. Okay. So the moment you start accumulating the profit, okay, the account is getting bigger and bigger, okay, then you will make a very good living. All right, okay, from options. Okay, because why? Because when your account is start making money, your account start growing, okay, or you can, like I tell you, like every month, you just put in more, okay, you can using more, you have more strategy and more choice, okay, rather than you only can long call and long put or using spread only. Okay, the spread one actually is tomorrow, we're going to mention one. Okay, so basically this is how options can really amplify your return. Okay, and then you not only depend on the stock only, because I know that some people, when you look at the stock, the stock price not moving, and then the stock price go down, you will feel you, because maybe you have too much time unless those people don't have time one, maybe they can actually collecting stock for value investing, like what we mentioned in the value investing. Okay, but however in the options trading, you actually can always using different type of strategy to enhance your return. Okay, because the stock cannot like one day go up infinity one, no way. Okay, it always up down, up down, up down, up down, up down, up down. But during this period of time, how can you using options to help you to gain more profit? Okay, so you can try out a different type of strategy, and once you used to it already, okay, to be very frank, making 10, 20 or 30% per day is very normal in options. Okay, I say it's very, very normal. Okay, so guys, you have a question or not? Hello. Oh,
No
slightly.
question from me, Mike.
No,
No question.
so any
No.
other? Yeah.
No,
So
none.
okay, so now you don't have questions now. Maybe it's a time for me to ask your guys question already lah. Okay. Oh yeah, let's say you want to look at the chart, right? Okay, so basically, right, sometimes okay, there are actually a lot of argument now. Some of the option traders, they don't look at the chart one. They're only purely based on the range. Okay, to me, okay, I look actually both side. Okay, so basically they look at the range, because option trader normally they are actually a statistic. Okay, people who really emphasize on the accuracy of the statistic one. They sometimes, that's why sometimes the return is not so good, because they don't look at the technical analysis. Okay, so the technical analysis, if you can, you let's say you can incorporate it inside your option trading, is much better. Okay, I give you an example. Okay, okay, let's say you want to trade AMD. Okay, this is a 4-hour chart. Okay, so let's say we put into, okay, normally if you're a day trader, you don't look at 4 hours one lah. Okay, you can look up to 3 minutes or so, but normally I will start with 5 minutes lah. Okay, the simplest way, right? Okay, to trade, right? Okay, if you want to look at RSI, okay, the signal, here it start to green. And here also to confirm, normally, you know, lah, Dr. Mao always like to say one, the first confirmation, second confirmation, same thing, lah. Okay. So basically, if here, okay, the first confirmation actually is very, you can see already here is very strong support. And the second confirmation here is the RSI is turning green and going up. What you do here is you can long in the money option, $76. Okay. And okay, expire very, very soon. Okay, because expire very soon. Okay, the delta will be very high. Okay. So basically soon meaning that 1 week or even 2 weeks. Normally you don't more than 2 weeks. Okay, 3 weeks can also, but shorter better because your turnaround times is higher. Okay. There's some people argument, you know, not necessary, but to me, I think the turn you are actually want to your cash coming in fast, you know. Okay. So basically, let's say you buy $76. Yeah? So if let's say you are using you are a TA guy, okay, you can have you can using whatever confirmation your smart ruby or whatever it is lah. Okay, so you can say this one, but to me I look at a very simple confirmation, maybe RSI, maybe here I don't plot the so-called like, because when you're using TA, right, the more TA you have, right, the more you scratch your head, you know. Okay, I believe those people using TA will agree with me lah. Okay, let's say you insert 10 TA, right? Alamak, I can tell you, you are burning already. So I will always say normally don't use more than 3 TA. Okay, okay, 2 sufficient. Okay, 3 is good. Okay, so don't using more than 3 TA. Okay, so basically because we are looking at short term, so we are looking about 5-minute chart. Okay, 5-minute or 15-minute charts. Okay, so this is a very, very strong support. Okay, so when strong support come, you confirm again here actually it's an uptrend, turn green already. Okay, so it's a bullish trend. Okay, so it's bullish trend. What you do here is buy in the money. Okay, buy in the money. Okay, next week or next 2 weeks from now. Okay, that's it. The moment you're going in, if it go up $1, your option go up to 50 cents, cabut, that's it. Yeah, how many minutes here on you? Okay, 10 minutes. Okay, less than 30 minutes. Okay, good question. So some of the non-chartists, okay, especially people look at statistic number one, there are few good option traders are very good also because they are using probability. Okay, so basically they only look at number, they don't look at chart, you know. Okay, for me I look at both lah. Okay, okay, even sometimes both also not 100% accurate, but increase your probability. Okay, so basically, okay, if those people look at this, right, they look at the range, you know, like today range is $76. They look at the chart. Okay, one is reach $76 or near $76, they boom, they buy in long, okay, long call. Okay, and then basically you know, and they go up. Okay, because they know today range is expected like that. Okay, okay, 70% lah. Okay, probability is like that. Okay, so basically then they long call, and then once their profit achieve already, they cabut, that's it. Or they set the exit strategy already. Okay, okay, so they know that this stock okay, can go up $1 one. So if the delta 50 cents, easily I can make I mean, sorry, the delta 0.5, easily I can make 50 cents when the stock go up to $1. And my cost here is only $1, $2 only. So in terms of percentage wise, the return is much higher. All right, guys. So if you want to using indicator, yes, good. Okay. At the same time, okay, you using the delta that you learned tonight. Okay, then I believe this can make you good income already. Okay, again I will tell you already, not these 2-3 weeks lah. This 2-3 days lah. Okay, especially until the president elections okay, over lah, and everything start back to normal. Okay, because this 2-3 days is a bit like gambling because we don't know who is winning. Okay, and even we know, so we don't know how the stock market will react. Okay, so again, you can see if let's say you are a TA guy, It's very simple, guys. You look at this. Okay. I mean, even you don't need to study whatever it is, lah. Okay. I mean, you just plot a line here, lah. Okay. You can see. Okay. Here is basically what. Okay. You can put a line here, and then you can know that you can short here. Okay. You take profit here. You know what I mean? Okay. So basically, you can short, you can buy a put here. Okay. But if let's say you buy a put here, where the price go down or not, again, or you think that, okay, if this is a strong support and it break here, you can buy the put in the money. Boom, it go down $2. Okay, and you can, but normally I long this, I play is a long side, you know. I don't like to look at the put side one. Okay, but if you like to long the put one, you can look at the downside. Okay, you see or not? If you long the put yesterday, 2 days ago, you can make good money. All right. Okay. Why? Because the stock market go down a lot yesterday. Okay. So if you long the put, okay, then you can make easily $1.80. If the delta is 0.5, you can make 80 cents. Your put maybe only how much only? Okay, maybe about $1-2 only. So in terms of percentage, why you're making a lot? Okay, if compared to stocks. All right. Okay. So this is how you're using a simple technical analysis. Okay, because we are not like a fully chartist. Okay, because if you're fully chartist only, okay, you don't have a probability with you. However, when you play options, you have the probability with you. Okay, so when you have the probability with you, and you know the nature of the stock very well, okay, it actually will give you a very good advantage, okay, to make money. If compare, you don't have any advantage. Okay, so this is how you long the call and long the put in the money or dip in the money if you want to, okay, bet the directions. Okay, okay, you want to actually make money from the directionals lah. Okay, directionals can be up or down. Okay, so if you want to play longer terms, okay, you can look at the day chart or 1 hour TA. Okay, so you want to look at the 1 hour TA, you can see, oh, here actually this stock I don't think will go up more than $86. Okay, example lah. Okay, so what you do here is you well buy a put here. Okay, or you can buy a put, okay, down here also if the put here is very expensive, because this is in the money. Okay, you know what I mean? Okay, so when the stock go down, you are making money. Okay, so but I tell you, when you buy options, the biggest enemy is time. Okay, because one times is decay your premium, well, slowly gone, you know. Okay, that is actually when you buy the option, unless you are very confirmed about the directions of the stocks. All right, guys, you see, okay, in AMD, I give you an example. I'm wrong actually, you know, but somehow now I still making money, okay, for AMD, okay. Even you wrong, you still can make money one, okay. Why? I give you an example, okay. Before the earning, a lot of people have a high expectation, okay. So what I do here is actually I'm at $80.05. I'm actually short the put, because I believe the stock will be above this line one. Okay, now try to look at the position that I tell you. Hold on for a while. Okay, AMD. Okay, you see I short 2 contract of put here. Okay, because I believe the stock will go up beyond this level. However, now I'm wrong. However, I'm making money, I'm losing money now. Alan, are you there?
Yeah, yeah, yeah. You're making money, no?
Yeah, I'm
Okay.
shorting the put. By right, okay, if I shorting the put here, okay, because when you short the put, it's opposite at the along the put. What happened? You are not making money, okay? So now actually I still making $78. Today itself, I'm making about 300 something. Okay, because when I short the put, I have the right to buy the stock at $80.50 and I collect the premium buta buta at 600. Okay, so basically, if tomorrow the expiration is, you look at the expiration here is 30th. If tomorrow the price expired at $80.50, hallelujah. Why? This $600 is mine already. If it is not, I still can using new strategy to counter it and make money again, as long as the price does not go down heavily. Okay, okay, because the strong support here is 75 to 80. So as long as the price is not go down, maybe below 70. Okay, so in long-term basis, as long as the price hovering around this area, I will making money. You know, so that is actually the good thing about options. You know, but if you buy stock, if you buy at $80.50, are you making money now or not, Jimmy?
No.
But today I'm making money, right?
Yes. Yes.
Okay, so this is another strategy where actually you can use, okay, okay, if you have a bigger capital, because when you short the put, you need to protect it by the cash at your account. Okay, okay, so basically this actually give you another advantage. Okay, even if you are wrong, you know. Okay, so what I tell you guys, right? Okay, so basically even you are wrong, you still can make money. Okay, if stock you are wrong, you just have to wait until it go up. Okay, and you cannot collect rental also, which actually this is the topic we're going to touch tomorrow. All right, okay guys. It's better, okay, because when you long, okay, the options, okay, if you select too long one, right, okay, if suddenly the direction is wrong, right, okay, because the delta actually is not that high. It's not only delta, other factor also, okay, because why I thinking about why actually you select the options 2 3 weeks or 1 month, the maximum is 1 month from now on, because the delta still got impact, especially in the money. And then another thing I tell you guys here one, okay, the stock you need to select one is a high beta stock. Okay, have to remember that the high beta with a high implied volatility one. Okay, and in
And
money.
and I think Mike, I think it's also because this time you show the chart, right? It's all about the intrinsic value also, because between that period the intrinsic value is more.
Yeah, you of course when you are in the money, the intrinsic value is there. Okay, actually when you in the money, okay, definitely there's all intrinsic value already plus the extrinsic value. You get me or not? Okay, so basically your probability, okay, profit probability is by using the day range, you know, meaning that you jangan buta-buta masuk, you know, you short masuk, short no, cannot. You must wait until the day low and day high. If you malas to do that, okay, what you do, you can actually set the price. Okay, roughly let's say this price in the money now. Okay, if the price go down, what is the option price you can roughly estimate? So you set that price. Okay, if kena lah, like punching, you know, okay, like fishing, if kena, the chances, the higher chances probability, okay, you will make money when the directions go up again. Okay, that's why you need the chart also. Sometimes you look at it, but the simple chart, I think 2 indicator enough already. Okay, maybe like support and resistance and using the RSI. Okay, and if you have more indicators, it's up to you. Okay, but if you have many indicators, no way. Okay, don't use more than 3 indicators. Okay.
Mike, you are using which RSI? Because there are a lot of RSI in the inside trading view.
I'm actually based on the times and this simple RSI. Your name is a simple RSI. Okay, it's a simple RSI. Okay. In fact, actually, yeah. In fact, actually, okay. Let me check. Okay.
Yeah, can you show it to me that which you should go to the function there, the FX there. Then we click that one. Okay, I share the diversion. Let me take a photo first. Shiraru. Okay.
Actually,
No,
guys, hey, actually, I tell you, this is actually, I just pick it one, you get me? For me, actually, right, okay, it's not necessary saying that, okay, because people say convergent, divergent, okay, sometimes for long, for the short period like this, 5 minutes one, right, it's not necessary, right? You get me or not? Okay.
But I like your green and your red one, the indicator.
Yeah, lah, it look like really like showing the things, move accordingly, lah. You get me or not? Okay. So basically, this is how you can use some chart, lah. You see or not? Okay. So normally another thing you can look at is the volume. Okay. So normally, opening the high volume, right, it will follow by uptrend one. There's also another way I trade, lah. Okay. The volume and the momentum you can see, right? Okay. You can see the volume here, right? Okay, the first 10 minutes very high, and then it break through the resistance and it continue go up. Yeah. So normally, let's say I go in here, right? When the price come in here, I will observe already. I will start observing whether the momentum is high or not. Okay, if the momentum is high, okay, I will leave it there. Okay, meaning that you can see the uptick is keep going up lah. Okay, you can see uptick and downtick one. If the downtick is still there, and hovering there, right? Okay, I will get out maybe 10%, 20% return also to cook already. But if I wait, okay, I can get maybe 30, 40, 50% already. You know what I mean? Okay, guys.
Okay, Mike.
Boleh ya, semua boleh ya? Okay. Jackson Tan, boleh?
Okay.
So now, I hope everyone, okay. So I think that's all for tonight. Okay, so again, I hope you guys learned something tonight. Okay, because option is really actually I really like option a lot lah. Okay, you see or not? As a traders for the last 10 years, actually Starbucks I trade a lot of option also, just by using 1 or 2 strategy. Because last time, because Starbucks normally it's very difficult to using long call and long put because of the beta is not so high, and then the IV is not that high also. Okay, unless you are choosing a high beta one. All right. Okay. Thanks, everyone. Okay. So tomorrow night, okay, I see you guys lah. All right. Okay. So that's all. Let's say for tonight. Okay. So any questions? We will discuss tomorrow. Tomorrow night we will talk about how to collect premium. Okay. How to even you are wrong. Okay. I already actually tell you already tonight lah. Okay. Even you are wrong, you still can make money. That kind of thing. All right. Okay. So that's all. Okay.
Okay.
Cheers.
Thank you, Mike. Thank you.
Thank you, Mike.
Yeah. Good night.
Okay,
Thank you, Mike.
Yep.
Thank you,
for the
Mike.
time.
Thank you very much.
Bye.
Thank you. Good night,
Bye.
everyone.